All right, the market rally since March is boosting the bottom line of at least one money manager. Legg Mason reported its second straight quarterly profit today. Earnings for its fiscal second quarter were 30 cents a share, 8 cents better than expected, and a whole lot better than the 77 cents a share loss the company posted last year. Joining us now is Mark Fetting, the chairman, president, and CEO of Legg Mason. Mr. Fetting, it's great to have you.
It's great to be here. Thank you.
So a good earnings report, but many of your investors are still real concerned about outflows. You had an improvement there, $8 billion in outflows versus what was it, $30 billion in the second quarter.
Right.
But still, you've suffered 8 quarters of net outflows. So when can investors expect Legg Mason to report positive inflows?
Well, we are clearly on the cusp because what we've taken that outflow number from a rate of 9% to 6% to 5%. Now this quarter it's just 1%. So you can see it coming very shortly.
Is it all dependent on the improving market conditions of the last 2 quarters?
Not at all. That certainly helps, but what we've had is improving performance across our key managers, whether it's Western in fixed income, Legg Mason Capital Management, Bill Miller's group in the equity side, and Permal in our alternatives business.
Boy, you mentioned Bill Miller. He's had quite a turnaround, what, 38% year-to-date up, ahead of the benchmark by 16%. Of course, Bill Miller, the Legg Mason Value Trust Fund, this is what I'm referring to.
Yeah.
Are you looking to, or first let me ask you, how much new business is Mr. Miller himself drawing for you?
It's really encouraging. They had, for the quarter, a positive flow, albeit very modest, but it was the first positive in a good many quarters, so that's very encouraging.
So you mentioned in your conference call, I believe it was a call earlier this morning, that Legg Mason is looking for additional acquisitions. What types of managers?
Well, we're looking for, we have $700 billion under management now. We have 8 core managers, many of which are respected to be the best in their space. So we're looking for complementary skills, and some of which could be bolt-ons to our existing managers, some of which could just be lift-outs, teams joining our managers, and then we are looking at selected but targeted acquisitions that would round out our overall capabilities.
Can you give me a time frame when we could hear announcements?
Well, I think both on the bolt-ons and the lift-outs, they're likely to come sooner, and we're certainly got a good pipeline, so over the next quarter or so. I think the acquisition is probably a little further out because we want to move sequentially.
I want to ask you about your compensation plan. You announced a new plan today. You're tying compensation to performance. Given that we are hearing from the Payzar today, Ken Feinberg, did you feel pressure to change the way Legg Mason compensates?
Not at all. We've been I was appointed CEO just about 2 years ago, and we've worked with our board closely and the new management team to put together a new compensation plan. And we've had that undergoing for some time. The key is accountability around metrics and improvements, whether it's margin, performance to our shareholders, or net flows in terms of going back to your first question, getting them positive.
How do you feel, though, about this proposal, the average cut, 50% for the top 175 workers, and a cash salary cap of $500,000?
Well, I think there is. Well, I think there's an added burden for those where the government money has really come in and helped save the institution, and that adds an added requirement in terms of compensation accountability. We had some tough issues. We've resolved them ourselves. We raised the capital ourselves. We had no government assistance, and I think those kinds of situations are a bit different.
Are you talking about how you had to prop up some of your money market funds that had invested in some of this troubled debt, and how have you changed your risk profile?
Well, Western, our manager there, has really been very robust around bringing in new risk management talent, putting in procedures, and it's around things as simple as concentration limits and really drilling down on the credit side.
You're involved in the PEEPIT plan. This is the public-private investment program designed to help financial firms unload toxic assets. What can you tell us about your participation? Have you actually gotten a hold of any of these toxic assets yet?
No, we are right now, we're one of 9 firms that were selected, and a few have hit the minimum. We're still working with our institutional clients to do that. We should be reporting it very soon. Then we'll begin investing.
What is the draw for you to be involved with the PEEPIT?
Well, ultimately it's an attractive opportunity of investment for institutional clients, in that the government's basically taking this PPIP eligible paper, what was truly AAA rated residential RMBS and CMBS paper, providing some added but prudent leverage that will enhance the return, and that should give better returns for the investors who are willing to take that risk.
Getting back to Bill Miller, I was starting to ask you this earlier, interested in attracting this sort of celebrity money management fund manager type that he is? Are you looking at getting some new names, personalities?
Well, we have always sought the best in each of the individual asset classes. We have Chuck Royce's firm, who has a number of managers, Whitney George among them. Bill has Sam Peters. So we do like to get the best. It doesn't necessarily mean they have to be, quote, stars, but they got to meet that standard.
All right. Unfortunately, Mark, we're running out of time. Mark Fetting is the CEO of Legg Mason. Thanks for coming in today.
Thank you both for having me.